Hello everybody and welcome back on my channel. Today we're going to look at John Deere and I prepared a company and stock analysis. You will learn a lot about agriculture machinery, heavy machinery in general, and also you will get to know that John Deere produces quite a huge range of products. Quick summary, we're going to look at the company history, the corporate divisions, the product portfolio, the competitors, the revenue, net income and stock trends, the dividend history and its key figures, and in the end we're going to look at the chances and risks I could come up with, and you can be free to discuss those in the comments below. Starting off with the history, John Deere was founded in 1837. And today we are in 2020, so it's 138 years old, the company, like very old company. It was founded in Grand Detour, Illinois by the blacksmith John Deere to produce plows for thick prairie soil. I basically just advise you to just look at some of the pictures. And as you will see later on, it's a great summary of how the agriculture heavy machinery industry has evolved in the last 183 years. 10 years later, in 1848, John Deere forms a new partnership and moves to Moline for the Mississippi River, or basically on the Mississippi River. So we were starting off in this small town down here, Grand Detour, and then they moved basically a 1 hour drive down to Moline, a way bigger city, which lies on the Mississippi River, which is good for transport and logistics reasons, of course. Then 29 years later, in 1877, Deere starts to manufacture corn planters next to the plows. You can see like this wagon of plows, just for background. In 1883, so 46 years after foundation, the walking plow is still the most important product. That's why I put this picture here. In 1886, the year of John Deere's death. And there's a quote from shortly before his demise in which he said, during his long life, it had been a great source of consolation to him to know that he never had willingly wronged any man and never put on the market a poorly made article. And I think this is, in general, for a great way to live, especially if you're in the manufacturing business, of course. But I like this quote, that's why I'm mentioning it here. Then next up, in 1892 marks the year the first gasoline-powered tractor was invented, not from John Deere, but from John Fröhlich, or Fröhlich. And as we see here, John Deere will acquire the successor company, the Waterloo Gasoline Engine Company. In 1918, John Deere enters the tractor business by buying the successor company of John Fröhlich's first gasoline-powered tractor. That's down here. In 1927, Deere introduces its first combine, that's on this picture, and in 1935 the first industrial tractor. So that's John Deere's first real industrial tractor. In 1947 the versatile Model M tractor is the precursor of Deere's construction and forestry business. That's the guy. In 1958, the introduction of the construction equipment division. As we see later on in the product portfolio overview, that's quite an important division for John Deere, besides the, of course, main agricultural division. More to that in a few seconds. 1963 marks the introduction of the consumer equipment division, which is today's turf division. That's this one. So before that was solely B2B, even though the B2B term probably wasn't invented by then. But here they enter the B2C business as well. In 1964, Deere and Company headquarters is opened, and this is still their headquarters until today. There are advances in tractor manufacturing and safety standards, so this already looks a lot more like our today's tractor than the pictures we saw first. And then in 1971, Deere introduces a snowmobile, and this sub-brand was sold 13 years later, but its slogan, "Nothing runs like a Deere," is still being used today, and it's of course also trademarked by John Deere, but it originally comes from the snowmobile, which was a flop for John Deere. Then, in 1988, the Deere enters the excavator business in a joint venture with Hitachi first. And again, look at the evolution of the tractors and the combines, of course. In 2000, John Deere enters the forestry business by acquiring Timberjack. So you see more and more of its today's business units were opened along the way. And I also found this one very interesting. This is a cotton picker. Me, as I'm living in the middle of Europe, I have never seen a machine like that, but maybe you have. Then, lastly, in 2017, Deere acquired the German Wirtgen Group and hereby enters the road building business. So that's another new division, as we will see just now. Corporate divisions. John Deere basically splits itself into the agriculture and turf division that makes up 68%, and the construction and forestry division that makes up 32% of its revenue, based on the 2019 numbers. Then the construction and forestry unit is split up again into construction, so excavators and so on, road building that was just acquired with Wirtgen 3 years ago, and the forestry business, the compact business, and other. Same on the agriculture and turf side, which is of course the most important, the more important one of those two. This is divided into large agriculture, small agriculture, turf. And turf, as we just got to know in the history, was, or basically is, consumer equipment. This is the chart as a whole. So of course, agriculture, large and small, is by far the most important sector, but also this pretty new sector, construction, road building is pretty new with 9%, and construction, but together they also make up like one quarter of John Deere's revenue, so you should not overlook them. Then, so what does large and small agriculture actually mean? What products do they produce? What is out there, and what is going around farms nowadays? Of course, there are large tractors and mid-sized tractors. There are combines and forage harvesters. Then we also have mower conditioners, ballers, sprayers, front loaders for the tractors, and seed drills in the large and small agriculture division that make up together 57% of John Deere's revenue. So these products you just saw make up 57% of John Deere's revenue. Then turf, or formerly known as the consumer division, riding movers, lawn movers, golf equipment, some more golf equipment, professional ground clear, which is probably also a lot of golf equipment, and for communal services, and the most likely famous John Deere Gator, which is like a golf cart style off-road vehicle. Then we have some compact tractors. I think everyone can relate to that. Then forestry. I learned that there are harvesters that actually cut the trees, and then there are forwarders that move around or transport the cut trees. Before I dove into John Deere, I thought this is basically the same machine, but it isn't. And they make up 4% of John Deere's revenue, so not so much actually. The construction business unit on the other side is way more important than the forestry one, with 15%. And construction only means construction, not road building or road construction. This is separate. So we have articulated dump trucks, backhoes, compact track loaders, crawler dozers, crawler loaders, motor graders, compact excavators, mid-size excavators, large excavators, skid steers, scrapers, tractor loaders, compact wheel loaders, mid-size wheel loaders, and large wheel loaders, and then a whole lot of attachments. Then, now, finally, Roadbuilding, the newest business division from John Deere, made up 9% of 2019 revenue. And the whole road-building business is basically the Wirtgen Group, now a John Deere company since 2017. In 2017, John Deere acquired the German Wirtgen Group for 4.4 billion euros, so probably 4.6 billion US dollars. And I wanted to mention that John Deere company itself has 48 billion USD market cap. So quite a noticeable acquisition there. And then the Wirtgen Group itself is a whole concern or big company in itself, because it's got its own brand, the Wirtgen brand, then it's got Kleemann, better do it here, then Bennighofen, Hamm and Vögele, and those were all smaller companies that Wirtgen already bought some years ago. So then, Wirtgen itself does cold milling machines, recyclers and soil stabilizers, slip-form pavers, surface miners. Let's do it like this. Look at it. Maybe you can get a little bit more of the spirit. What do these machines actually do, or what are they used for if you see them in the picture? Surface miners, recycler and soil stabilizer, cold milling machines, slip-form pavers. I learned that slip-form pavers are for paving with concrete, not with asphalt. And again, basically they have all these machine categories in many different sizes, but I'm not going to list them now. Let's move on quickly. Vögele, road pavers, screeds, power feeders, and Vitos paving. So I learned that this is the actual paver, and then you might be wondering, what does the power feeder do? It basically, you can imagine the dump truck comes in here and puts the asphalt in here, and this just transports it onto here. So This falls then down here, goes into here, and goes on the road. So road paver and power feeder, most of the time they work together. And then again they have smaller classes of everything for paving, sidewalks or anything like that. Then Ham, they make the rollers, tandem rollers as well as pneumatic tire rollers. And here I learned that these pneumatic tire rollers need the subfloor and spare embedded manholes. That's what they are used for. Then we got Kleemann. They have mobile door crushers, mobile cone crushers, mobile impact crushers, mobile screening plants. Yeah, highly specialized, but you certainly need it when constructing a road. Then Bennighofen is also very interesting because they make asphalt mixing plants or recycling plants. And the eco version is a completely movable system. So it's built out of modular shipping containers, and it's not a permanent asphalt mixing plant, which is good if you have huge highway construction projects. You need a mobile asphalt mixing plant, and those ones are stationary obviously, but yeah. Then quickly talking about other John Deere companies, I found out that Camper is an accessory brand, Sabo lawn mover for consumer lawn movers, and Frontier. I don't know too much about that, but maybe you do. Then also very interesting to me, the main competitors for John Deere that I was able to find out. I only focus on large agriculture, small construction and road building. Large agriculture, what are the biggest tractor names besides John Deere? That's the group, the CNH Industrial Group. So these rectangles always mean that it's a group. They have the brands New Holland and Chase. Then JCB, Independent and Claas is a big one in Europe. Then we have the AGCO group with Massey Ferguson, the Challenger brand that they bought from Caterpillar some years back, and the Fendt brand, which is also, from what I know, very important in the middle of Europe at least, and Kubota on the more smaller side. Then coming to construction, we have JCB again, we have New Holland again with their construction division, we have Chase, of course they also all belong to CNH. We have the big elephant in the room, CAT, maybe the biggest competitor to John Deere in general. I learned that the biggest construction companies in the world are Caterpillar at number 1 and Komatsu at number 2, and together they have about 80% market share, so those are the big names in the construction business. And then you get some smaller ones like Hitachi, Kubota again, the German Liebherr, Bobcat, Yanmar, Volvo, Terex, also a US company. Yeah, and then let's also quickly focus on road building. There's a manufacturer called Amann and the Fiat Group. They own Dynapac and the Bomag. Yeah, they basically also do rollers and pavers and all what we just saw before. Then quickly, the Deere Co has somehow different and unique accounting year. So their Q1 goes from November to January, including both months. And then their Q2 goes from February to April, and so on, as is listed here. I hope this diagram is not too confusing for you. So they had their Q1 closed in January already. That's why they already finished their Q2 earnings. They already came out, and we're going to look at that just now. So what you can see is the revenue trend quarterly since the Q1 of 2005. Yeah, and I would basically say you can see two things. Some general waves, this one, and then we started a new wave. And what you don't see at the first point, but Q1 is always the weakest quarter. So let me see. This is Q1. This is Q1. This is Q1. This is Q1, and so on. And Q2, on the other hand, is always the strongest quarter. So this was Q1. This is Q2. Q1, Q2, Q1, Q2. And hereby you can see it's a very seasonal business, and especially in the winter time, as we go back here for a second, Q1 is basically end of autumn and the beginning of winter, so that's the toughest time where John Deere gets the least revenue. Yeah, and it's always been like that. And you see general waves. And of course here this wave this downward trend was caused by some financial crisis turmoils. Yeah. Then revenue trend. So again, this was revenue quarterly, this is annual. In 2005 they had a revenue of about 21 billion US dollars. And in 2019 they reported 39.3 billion US dollars, and that's an increase of 85%. And as we would calculate the compound annual growth rate, CAGR, over here, that would mean they managed to increase their revenue annually on average 4.5%. During the last 15 years, which is not too bad, I believe. Then, coming from revenue to the net income trend, what you can see here is that the net income grew faster than the revenue, because we have a CAGR of 5.9% per year and a 4.5% per year. So for now you can just memorize CAGR stands for how much you were able to grow the key indicator on average per year. We will get into CAGR in a few minutes. So that would mean that the revenue the net income grew faster than the revenue, means John Deere as a company became more productive. So they were able to squeeze out more income out of the same revenue. Okay. And also here, of course, you see the same waves as we saw the revenue. Then putting them side by side, again here you can beautifully see the waves, and what you can see as well as the seasonal and cyclical company. Of course, revenues generally are higher in periods of economic prosperity and expansion, and are lower in periods of economic downturn and contraction. As we saw in 2009 with the financial crisis, or here with, I don't really have a name for that, but it's a cyclical company, and it's a seasonal business. So seasonal meaning you have Q2 always the weakest, Q2 always the strongest, and not by just a few points, but by a huge percentage. And the cyclical means these bigger waves. Okay. Yes, and of course you can see the gap between revenue and net income widens in times of economic downturn, and this is caused by a loss in productivity, which is totally normal. And then normally when the economy gets back on track, you get these lines back together, and that stands for gaining some productivity again. And yeah, if you calculate that here, that's a 7.3% net profit margin. Operating income, just a quick look. CAGR 4.8% per year. Always positive operating income. This is not self-evident in this capital-intensive industry. And what does operating income mean? Yeah, it's helpful to investors since it doesn't include taxes and other one-off items that might screw profit. Operating income is the amount of income a company generates from its core operations, meaning it excludes any income and expenses not directly tied to the core business. Operating income is calculated by taking the gross income and subtracting the operating expenses. Just as a quick background. Then, moving to the stock trends, you can basically see when the revenue and the net income go down, stock goes down as well. If they go up, stock goes up as well. Yeah, but here we saw, you could maybe argue that you saw a slight detachment of this curve, but maybe here also to the other side. But I think, of course, you cannot track it one by one, but the main takeout of this graphic is if profits and income and revenue falls, stock price will follow, and the other way around. Okay, coming to the stock trend in general and to the CAGR. Yeah, CAGR is the compound annual growth rate, as I said before, and it's the mean annual growth rate of an investment over a specified period of time longer than 1 year. It represents one of the most accurate ways to calculate and determine returns for individual assets, investment portfolios, and anything that can rise or fall in value over time. I thought you could take something out of. I hope you could take something out of that. And for John Deere, excluding dividends, yeah, if you just bought the stock in late 2004 and held it up to today, you made a 362% plus, and that's calculated on 15.5 years roughly, a CAGR of 10.5% per year, which is, as we will see in a few seconds, quite impressive. Then, of course, more important, including dividends. Yeah. So here we were with excluding dividends, we are at 360, and now we are at 485%. Of course, that already tells you that John Deere pays a dividend, and we will get into that deeper now. And that causes a CAGR of 12.3% per year in the last 15.5 years. Yes. Then let's look at the dividend history. On a quarterly basis, first for the last 15 years again. We are starting in late 2004 with 14 US cents paid out in dividend, and now you get 0.76 US dollars per share you own in dividends per quarter. And that reflects for 11.7% dividend growth per year in the last 15 years. And this is very impressive to me for a manufacturing business. So then we're going to look at the same numbers for the last 5 years, and there you only see a 4.8% dividend growth per year, and this is caused by this long flat line of not increasing anything. Of course, when those was the time as well when the company wasn't really increasing revenue, so that's why they didn't grow their dividend, which is fine. Yeah, in times of economic downturn, as we saw here, or in 2008, 2009, they just hold up their dividend. So summarizing, the dividend stays flat in phases of economic downturn, but was not lowered in 20 years. In 2000, so 20 years ago, they decreased the dividend by 4.5%. But yeah, basically takeaway, dividend was not lowered in 20 years, but is definitely not always grown year per year. Yeah, and what can you take out from those numbers here? The 11% dividend growth over 15 years and the 5% dividend growth over the last 5 years. Maybe you can estimate that the future will bring something in between that, so maybe looking at the 7% or 8% maybe. But of course, I don't know what the future holds. We can only try to learn from history. Yeah? History doesn't repeat itself, but it most oftenly rhymes. Then, continuing with the dividend key facts, yeah, the 20-year dividend yield average is about 2%, a little bit more, like 2.1%. I think that's where we're also standing right now. Then 15-year dividend growth was 11.7%, and the 5-year one was about 5%, as we just discussed. The dividend payout ratio for 2019 was only 29%, which is pretty good. Dividend payout ratio, what is this? It's the dividends paid divided by the net income, or the dividend per share divided by the earnings per share. You don't end up with exactly the same results, as we will see down here. So this is calculated on dividend paid divided by net income, is a 2019 average of 31%. And if you go for dividend per share divided by earnings per share, that's an average of 32.9%. Yes, so 29%, what does it mean? Basically, they spend the rest, basically 70% on something else of their profit. So, and what do they spend it on? Of course, as most companies nowadays do, John Deere also does repurchases. So they repurchase their own stocks, and they're spending about 38% of their income on that. So they spend more on the repurchases than on the dividends, but roughly the same. And dividends paid plus repurchases make up 70% of the net income, so they got 30% left to invest it into other things. Then finally come to chances and risks. What could I come up with? For example, we have the general trend of electrification of drivetrains. Battery electric and hybrid drivetrains are coming up for cars, and most likely will triple into tractors and combines and construction equipment in the next 10-20 years. So this is a challenge. Then automatization and autonomy. So you've got autonomous driving tractors. They basically have a lot of this already today. Then upscaling of farming and consolidation of farms. So there are less farms with more professional equipment. Alternative forms of farming, example vertical or urban farming, hydroponics, cultivated meat or food. Of course, those kinds of farming would threaten John Deere's business a little bit, because you don't really need tractors for hydroponics or for cultured meat and food. Then changes in food preferences. If people decide to reduce their meat consumption, we just call them vegetarians and vegan people. Also think about not just the agricultural side, but also the construction and the road building sector, which together makes up at least 1/4 of John Deere's business and might get more important in the future. What I really like about these purchases is that John Deere tries to diversify their portfolio of products away from just agriculture, because we said it's a seasonal and cyclical business, and with this kind of diversification, they will try to smooth out these effects a little bit. So for construction and road building, probably less cars in some regions, but on the other hand also urbanization. Roads always have to be renewed and maintained. So I think that was a good acquisition of the Rudkin Group. Then fundamentally, as we said multiple times, John Deere is a seasonal, cyclical and capital intensive business, and therefore you should also factor in price changes in commodity prices for steel, oil and so on, because that will directly affect their net income. Then as a summary, I'm giving you all the business units again and the names you see around here. Let me know, maybe I should look at one of the competitor companies like Caterpillar or whatever you like. Please feel free to make suggestions down in the comments. And then I thank you for watching. Please consider to subscribe, and what company would you like me to analyze next? Let me know in the comments below. Remember, just be lekker. Bye bye.